Good morning and welcome to today's webcast, Cash Management and Cash Flow Strategies for Construction. Before we begin, I'm going to play a brief housekeeping video.
Welcome and thanks for joining us. We're pleased to present another in our ongoing series of continuing professional education webcasts to help companies and individuals conquer challenges as they plan for what's next. Our presentation will start in a few moments. Before we begin, here are a few things to keep in mind. You can customize how you both view our presentation and interact with the presenter. For better viewing, close all other applications and turn up your speaker volume. You can also adjust window size and placement or enter full screen mode using the controls at the top of the window or dragging the bottom right-hand corner to resize. At the bottom of your screen, you'll see a series of icons, each relating to a different aspect of our session. You can download the group attendance sheet and a PDF copy of today's slides from the slide deck and handouts widget to the right of the slide view. You can ask our presenter questions during the webcast by typing a question in the Q&A window below the slide view and clicking submit. We'll do our best to answer all questions during the presentation or follow up via email. If you experience technical difficulty during today's presentation, refresh your browser by hitting the F5 key. Today's session will offer you 1 CPE credit. To receive credit, you must meet the requirements as specified by the National Association of State Boards of Accountancy. You must attend at least 50 minutes of the session and respond to at least 75% of the polling questions, which we'll ask throughout today's presentation. To respond to a poll, click the button next to your answer. We'll track your progress and alert you when you've earned CPE credit. You can then click the certificate icon in the CPE Progress widget to open a PDF file that you can save to your computer. Don't worry if you can't download your PDF certificate today. We'll email a copy to you in 2 weeks. If you're attending this webcast in a group, you must complete our attendance sheet to receive CPE credit. The attendance sheet is available in the slide deck and handouts widget. Please have all group members sign it and send only 1 sheet per group. Also note that CPE credit can be awarded only to participants registered as themselves and isn't available to participants who view the on-demand version. As a reminder, the presentation you're about to see isn't legal, investment, or accounting advice. We encourage you to seek the counsel of a professional service provider to apply this content to your specific circumstances.
With that, I will turn it over to today's moderator, Elaine Ervin, Partner and National Practice Leader for Construction at Moss Adams.
Thank you, and welcome to our presentation today. So good to have you join us. You know, cash flow and corporate treasury management has always been a very important function within business. But with the emergence of the pandemic and all the uncertainty that it's created, I think it's become increasingly important to continue to make sure that you're modifying your cash flow as events occur. So therefore, this is why we're talking about it today. We're blessed and welcome to have Faulk, a BA partner within our construction practice, join us. McFarland, an advisor within our wealth management advisor group, joining us, and then Michelle Walker, the Director of Investment Strategy. And so with that, I'm going to turn it over to McFarland to begin our program.
Thanks, Elaine. We thought maybe a good place to start here might be our definition kind of a treasury function. So we think, an effective treasury function includes smart and strategic management of your cash flow, and excess liquidity. And obviously, we'll expand on some of the key operational areas here. I think we're going to do a lot of that today. But I also want to really look at kind of how this is done at the large institutions or public companies out there. I think there's a lot we can learn from some of those companies. And for me, Apple comes to mind. You've probably seen them in the news recently. They just became the first kind of publicly traded company to hit $2 trillion after doubling their valuation in the last couple of years. And that's kind of hard to wrap your head around, but they probably have, 100 to 200 analysts looking at cash daily, and they may craft some super elaborate investment policy statement, kind of chopping up their liquidity into finite buckets. We recognize middle market companies, don't always have the horsepower to allocate, those kinds of resources to this area, but I think it's really about how do you take the best practices from some of those highly successful companies and employ them in private practice. There's a host of practices that we can kind of take from them, and this is a big goal of ours today, is to talk about some of those practices. Before we kind of get into those concepts, though, I wanted to turn it over to Emily to ask our first polling question.
All right, our first polling question today. What type of organization do you represent? And your options are A, general contractor, B, specialty contractor, C, architect or engineer, D, professional services, or E, other. And I'll give everyone a few moments to respond. To participate in our polls today, please click the button next to the answer you choose and hit submit. We'll give everyone a moment or two on this first question. All right, go ahead and take a look at the results. Aaron, back to you.
Thanks, Emily. This is Aaron Faulk, everybody. Good morning. Thank you for joining us. Let's take a look at our results here. So pretty good distribution here. We've got 34% general contractors, 18% of the specialty contractors. So a lot of folks working in the contracting space, and then we've got a pretty significant group of other. So again, thank you for joining us. Looking forward to a great presentation today. As Elaine indicated, oftentimes as we get through these presentations, we will have questions, comments from the crowd. If we don't get to your question, please submit it anyways. We'll follow up with you after the presentation and try to make sure that any burning questions you have been addressed. All right, so as we think about our top performing organizations that Moss Adams sees and that we see, as Aaron indicated, in the public space, all those organizations have a plan to manage their cash flow, and their liquidity. And so when we stand back and we think about that, what does that mean? It starts kind of on the front end, and I'll talk about this in more detail in a few minutes about what kind of controls do we have in place, what kind of thought process goes into cash management and optimization of cash flow from your daily operations, and how does that line up with your organizational goals and your tax planning strategies? The second step of that is managing liquidity. So ideally, organizations are creating excess liquidity, and what is their decision-making process for managing that liquidity? And then the final kind of piece for these organizations is managing and evaluating how they're performing. So the controls in place to capture and report the results of their activities and see if their strategy is on track. And if it's not, recalibrate that.
So this is kind of the way we think about value, and looking at net enterprise value. You see dollars on the vertical axis here, and time on the horizontal axis. And so essentially we're looking at, the variable growth of different areas of a company over time. And you'll see four main buckets: goodwill, fixed assets, working capital, and liquidity. We often see companies spending a significant amount of time thinking about human capital, fixed assets, branding, new projects or activities kind of around those things. But we don't always see a huge emphasis on the bottom two part of this graph. And I think today what we're really trying to focus on is the synergy between working capital and your liquidity. There's we would say there's a lot of benefits there to putting a plan together and looking at those synergies.
All right, before we get into the nuts and bolts of our presentation, I thought it'd be helpful just to go over the overall discussion outline today. So in just a minute, I'm going to kick off a detailed discussion of our cash management and optimization. What are our top performing clients doing? What are some ideas that you can take away with you from this presentation to implement in your organizations? Following that, we're going to have an enlightening and conversation about what's going on in the market and what kind of economic trends are we seeing out there. Elaine alluded to it initially in our opening. It's a very unique time for organizations, for the marketplace, and so there'll be a lot of great information in that section of our presentation. Third section of our presentation is just related to cash management. How do you invest it? How do you think about liquidity? What are some vehicles that you can use in your organization to manage and invest your liquidity? And then we'll conclude with our wrap-up and then any Q&A that we might have received during the presentation. With that, I will kick it over to our next slide, which really just talks about why do we care about cash? Cash is really, at the end of the day, when we stand back and think about an organization or the organization you're involved with, the goal of that organization is to generate cash. When I think about a lot of my clients, they know that intuitively, right? It's cash from operations, it's cash at the date that they would exit their ownership in the organization, but sometimes during their operations and the day in, day out, they get focused on other things. I mean, I have some clients where I'm pretty sure their organizational goal is to acquire machinery and equipment. They love buying machinery and equipment, and they aren't always paying attention to what is the ultimate goal here. Is this machinery or equipment something that we have to have? Is it going to generate more cash for our organization than maybe a short-term buy or a short-term lease, something that we get the use of that equipment, but we don't have to maintain it. We don't have cash tied up in it for a significant period of time. So the lens that most organizations should be looking through is, how do we generate more cash at the end of the day? And is that a short-term cash view or is it a long-term cash view? And I would argue it's a long-term cash view, but we have to be very mindful of daily activity so we don't end up in a cash crunch, even though we're projecting out what our cash is going to look like in the longer view. When we think about the importance of cash, we also think about the indicators of health. So cash is a great buffer for uncertain times, right? It's very important in many of the working capital ratios. Many of the ratios that users of financial statements are looking at relate to cash. And that's quite frankly why one of the core financial statements that everybody has is a statement of cash flows, because it's that important for an organization to be able to articulate and for the users to see how that organization is generating and consuming cash. And one kind of note in this area is that trends are important, even in uncertain times or unique times. Looking at trends where cash is decreasing, receivables is rising, short-term borrowings are increasing or being maximized. Those are trends that are negative trends and things that you should be managing, especially in uncertain times. So the more cash you have, the more cash that you're deploying in a prudent fashion really speaks to the strength of your organization and your ability to operate going forward. All right, we're going to move into our second polling question real quick here.
All right, our second question. How often does your organization forecast cash flows? And your options are A, monthly, B, quarterly, C, annually, or D, never. As a reminder, if you would like to receive CPE credit for today's webcast, you will need to respond to at least 3 of the 4 polling questions. We'll give everyone a moment to make a selection. All right, let's go ahead and take a look at the results. Back to you.
All right, so our results, 58% are forecasting cash monthly. That's a fantastic result. That's higher than I've seen in a lot of our presentations. I'm not sure if that is due to the uncertainty in the current climate or not, but that's a fantastic result. And then another 25% on top of that. So for those of you in the monthly and quarterly buckets, great job. For those of you in the annual bucket, if you're already doing it annually, I think there's some great value to trying to convert that to a quarterly calculation. I know there is obviously uncertainty in the day in, day outs right now, but I think that there's a lot of value there And we'll talk about that as we talk about liquidity throughout this presentation. The more that you guys can dial in what you're expecting the cash flows to look like in your organization, that gives you a way to monitor them. And then as you're performing against that, it gives you a way to recalibrate your operations and some of the decisions being made in the organization. So I think that the monthly cash flow forecasting is a best practice. But a lot of organizations, they can get pretty accurate information on a quarterly basis to give them the information that they need. For those of you in the never bucket, I'm hoping that you're sitting on a fair amount of cash, and that's providing you with that buffer that you need for unexpected activities, unexpected claims or change orders in a contractor space where you're not able to collect the cash as quickly as possible. But the less visibility you have of your future cash flows, the more danger you're putting your organization in. All right. So a couple things related to cash and why forecasting cash is so important is one of the biggest things, especially in a contractor setting and in a manufacturing setting, is if you're a growing organization, cash is that fuel oftentimes that you're using to grow. The most dangerous time for a contractor is in a growth model. And the reason for that is that typically they're ramping up their expenditures, their costs, whether it's acquisition of materials for jobs, whether it's just the ramp up of the people, getting them out in the field. Oftentimes, unless they've done a great job on the schedule of values, you've got significant costs in the startup phase of a contract, and your billings are following that. And so if you're not careful with those types of environments, your cash consumption can be very significant. And so cash will fuel your growth. It's the same thing in a manufacturing setting where you're going to need raw materials, you're going to need inventory, and unless you have unusual or aggressive contract terms, you're not necessarily getting that cash up front for those expenditures. And so cash fuels that growth. We have a bullet point here related to, it also fuels new equipment sometimes. I will tell you that when I see clients, when I'm looking at their statement of cash flows and they're using cash to acquire equipment, that's a poor use of liquidity. Typically what we would recommend is that clients are using their short-term liquidity for short-term assets, whether that be job costs that turn into accounts receivable that then turns into liquid cash for you, whether it's inventory, something like that. But when you're buying a long-term asset, the best practice is to try to align that with long-term debt, and so you're not consuming liquidity there. Just a quick bullet point here, I touched on it just a moment ago, but the number one reason that for surety claims is unrealistic growth. So it's coming out of the growth side of the equation. It's very rarely is it when the economy is shrinking and people are scaling back operations, especially for contractors, because that's typically when their backlog is dropping off. They're actually pulling in cash from retentions and finalizing jobs. And so oftentimes when there's a pullback in the economy, contractors especially, they actually have more cash than they had maybe early on in the life cycle of a strong economy. All right. So I wanted to touch on ratios real quick, and we won't go in to great detail today on ratios, but ratios matter. And want to make sure that you as an organization are thinking about what your ratios look like. I threw up here for you some of the key ratios that are looked at and that you should be evaluating as you're going. They gave you some benchmarks there as well. Quick plug here, there's a lot of benchmarking data that is out there in the industry. The CFMA, so the Construction Financial Management Association, they have a very comprehensive benchmarking study that they make available for their members and that you can get your hands on. I would recommend for you, if you're a contractor, you should be looking at that survey. You should be benchmarking yourself. One of the things that is very powerful when you're working with banks and sureties and other organizations is to know what your benchmarking looks like and how you stack up to the general trends. Doesn't mean that you have to be better or that it's the end of the world that you maybe deviate, but you ought to be evaluating that and understand why you deviate and why that. Maybe it's a business practice, maybe it's an unusual contract, maybe it's the way that you're structuring your organization, but understanding how you stack up and how you'll be viewed by others, and then having a story to tell about why you might be different. It's a very powerful tool. It's a very powerful way to show the outside users that you're really paying attention to your business and managing it. So enough on that. If you need, if you want to talk about ratios or you want to touch base with me on benchmarking, be happy to talk to you about that, but lots of great resources out there you should be able to find very quickly on the internet for that. When we think about cash and we think about cash optimization, we also talked a lot about protecting cash. And, you know, as Elaine introduced me, I'm an auditor by trade, although I do a bunch of consulting as well. As we're auditing organizations, we oftentimes see frauds, and we see a lot of attempted frauds as well. And so I thought it'd be helpful to talk real quickly about some of the organizational internal controls that we see as best practices. Some of these are no-brainers, but you'd be surprised at how often we find they aren't actually in place. A couple of those relate to cash reconciliations need to be done. They need to be done timely, and they need to be done monthly, and they shouldn't be done by folks that can access cash, and they should be reviewed. That is a critical control. It's an expectation that you're doing that. If you're not doing that, or if it's not getting done timely, I really challenge you to get working on that. Some other controls and recent frauds that we've seen relate to buying of materials for jobs. Oftentimes, people are in the heat of the battle. They want to be able to pick up materials at their vendors. There needs to be very strong controls related to what can be picked up, how that's accounted for, and oversight on that. I just recently had a client that had over $100,000 worth of fraud where one of their project managers was ordering materials for the job, picking them up himself, and taking them to a house he was building in Eastern Washington. So organizational internal controls related to purchasing and to the cash management are critical. And quite frankly, for contractors and for those that have any size of business, they're just an expectation. It's not something that's optional. It's an expectation that they're there and that they're functioning. If I were to suggest one bank-related control that should be in place for everyone, is a positive pay control. There's a ton of fraud that is prevented just by having that positive pay in place, where the bank knows what checks should be cleared. Those checks come in, they get cleared. Almost inevitably, when we look at results from the bank side of it, there are frauds that are attempted on a monthly basis for our significant contractors, and that positive pay is eliminating that. The second control you should be thinking about related to your organization from a protection perspective is on the wire transfers, either defining where wire transfers can go, primarily reducing the ability for those wire transfers to leave the country, but also wire transfer limits and two-party verification or approval of wire transfers. It's remarkable to me, but there are still folks that are getting fooled by email requests for transfers of funds from someone that looks very much like someone that within the organization. The fraudsters are really strong and good at finding communication, people that may be out and using social media to find out a bunch of information that you would think that they could not have access to, but they have gotten to. And if you have an organization where people are asking you to transfer funds via emails and things like that, you got to have controls in place to verify that the right person is asking for that. All right. So how do we improve cash flow? And I'm gonna talk just a few minutes about how do we improve cash flow in a contractor setting. Looking at where our cash is trapped is the way to do that. So is it in underbillings? Is it in change orders? Where's our cash getting trapped, and how do we streamline our operations to avoid that from happening in the future? So the first three items on here really relate to job performance. following that, looking critically at the organization and saying, hey, do we have equipment? Do we have things that we don't need that we aren't putting to use? And then what are we doing to measure how quickly we're converting our change orders, our receivables, and retentions into cash? So benchmarking, again, is a great tool here. Taking a look at what your turns are, at what your days receivables are today, and making that an organizational goal provides great benefit. I had one client where the benchmark was 60 days to turn their AR. From an industry perspective, an electrical contractor, they were at 75, and we talked about it. We brainstormed some ways to improve that. A year later on the audit, they were down to 61 days. So they had improved their cash flow 14 days on receivables by really measuring it and being intentional about collecting and tracking both their change orders but also their receivables. All right, so I hit that pretty quickly, but there's a lot of operational things that you can do to improve your cash flow, and we just talked about those. And I'm hoping that you can, when you work through those operational cash flow models, when you're projecting those, you can improve your cash flow, and then that'll allow you to use that excess cash to either grow the business or for investments. So with that, Aaron, I'll throw the ball to you.
Great, thanks, Aaron. So how do you restructure cash in this environment? Obviously, it's a very low rate environment. I think Fed funds sitting at 0 to 0.25 today, and we likely aren't climbing out of this for a while. So the question is, what do you do? And to answer that, we wanted to provide some context by going through a bit of data, and maybe trying to peek around the corner on rates. But I think before we do that, wanted to kind of start with the concept of risk. And obviously, cash is king, and you have to have it on hand for a variety of reasons. This is certainly not an emphasis on taking that cash and moving it to some sort of risk-based bucket. I think that would stress out your third parties, like your bank and your surety. And this is not what that's about. You already take on enough risk in your business. And so I think what this really is all about is accessing shorter-term investment vehicles and or investments in the public debt markets. It's maintaining a high level of capital preservation while collecting an income stream along the way. And this is really why the debt markets are so large. You look at municipal debt, corporate debt, government bonds, agency-backed securities. There's huge demand for all of these. As you continue to see a lot of those bonds oversubscribed. So, even in a low rate environment, we're seeing that demand. So ultimately, when we're looking at cash, it's really making thoughtful decisions and decisions that are tied back to your kind of longer-term overarching strategy. Shortly, I'm going to kick it over to Michelle to provide some context on this environment. But, before I do that, I wanted to highlight kind of 4 main risks that we need to be mindful of when we restructure liquidity. And I think the common risk that everybody thinks about is market risk. So the risk that I bought something in 2008 and it went way down in value, or perhaps I bought it this last January and it wasn't looking so hot in March. I didn't see that event coming and I lost money on my investment. That's market-related risk, and it certainly exists. But I think that there's a few other more prevalent longer-term risks through rate cycles that we need to discuss. The first would be inflation risk. Think about what your cash is generating right now. The reality is that's a negative return, and as the value gets eroded. Liquidity risk, how efficiently can I turn my investment into cash? Default risk, I certainly don't need to, tell the story here. The question is, will I get paid back? And then the last item, and I think this is a critical one, would be interest rate risk. How do I keep my investments structured so that I'm not locked into kind of a lower return long term and not able to take advantage of a rate rise in the future? So with some of those risks in mind, I wanted to turn it over to Michelle. She'll take a deeper dive into kind of the economy and what the environment looks like today and perhaps peek around the corner here.
Thanks, Erin. And hi, everyone. So, I'm the really nerdy one who's going to be going through a bunch of economic slides for you, but I will do my very best to make them interesting. So we're talking about cash management today, and since cash management is typically done through the purchase of fixed income products, I wanted to do an overview of the dynamics that are currently impacting the credit markets during this really uncertain time. As you all know, in early March, it became pretty apparent that there would be a significant impact on the economy due to the coronavirus pandemic, and the markets, they reacted accordingly. The S&P 500 quickly dropped 35%. The volatility index, or the VIX, which is sometimes called the fear index, spiked to levels just we hadn't seen since the financial crisis. And the fixed income markets became, I call it disorderly. And what I mean by disorderly is that credit products like corporate bonds, investment grade, leverage, and high yield, municipal bonds, and mortgage-backed securities, they all dropped substantially in price as market participants really just were not willing to put forth competitive bids. So this loss of liquidity quickly caused investors to lose confidence and created some degree of panic. And during this time, even solid fixed products like government-backed agencies and treasuries did not trade well. So this is something that we really hadn't seen. We hadn't seen this kind of dislocation in the price action of the fixed income market since really the bankruptcy of Lehman Brothers back in 2008. Fortunately, however, the Federal Reserve has been to this rodeo before, so they already had the playbook on hand from 2008. And they really quickly just dusted it off and reopened some old credit facilities and were able to almost immediately inject several $1 trillion directly into the credit markets to shore up these dislocations. This enormous amount of open market purchases across treasuries, mortgages, corporates, and municipal bonds has totaled nearly $2.8 trillion. You can see this huge ballooning of the Federal Reserve balance sheet here on this slide that I have up. And it brought the credit spreads back into levels that are they're remarkably tighter than we saw pre-pandemic. So the Federal Reserve really did a super good job of creating stability back into the fixed income markets. And then as you can see over here on the right-hand side, that the Federal Reserve was not alone in this. There were large bond purchasing programs put in place by the Bank of Japan, European Union, and the Bank of England, among others. I mean, this was really a global intervention in the fixed income markets. So in addition to this massive level of Federal Reserve stimulus, the U.S. government also authorized $3.3 trillion in new spending to help combat the impact of the coronavirus shutdowns, including the stimulus checks, which you guys are aware of, to American households, and emergency loans and grants to struggling businesses and state and local governments. While the stimulus was much needed, it has pushed the budget deficit to its highest level since World War II, which has created some concerns about the potential for inflation out in the future. As you can see by this chart I'm showing here, this has put downward pressure on the dollar and caused gold to surge 16% this year to the highest level since 2012. So often people do buy gold as a hedge against inflation. So inflation is important to watch as it is not friendly to fixed income. As Erin said before, inflation erodes the purchasing power of the dollar and the value of a fixed coupon. Sorry, flipping the slide. Okay. As you can see in this next slide, inflation, at least for now, remains muted with high levels of unemployment. There's an abundance of oil supply out there, accompanied by depressed levels of oil consumption, really still muted demand for discretionary spending, and lots of excess capacity in the system. So we're not seeing inflation yet. Within these numbers, we have seen some pockets of upward pressure in prices, but mostly related to supply chain disruptions or virus-related anomalies in areas such as food, medical care, machinery and equipment, and some in construction inputs like copper and lumber. So while we haven't seen much yet, many economists are predicting future inflation due to this abundance of money supply that we were just talking about that's just been injected into the economy. And the dollar and gold charts we just looked at are certainly telling that same story. When trying to get into the head of the Federal Reserve, though, I will just mention that last week, Federal Reserve Jerome Powell, the Reserve Chairman Jerome Powell, he noted in a prepared speech that the Fed is more concerned with high levels of unemployment right now and actually deflationary pressures than they are with inflationary ones. He's also signaled that the Fed would even be inclined to allow inflation to run a little bit hot over their 2% target to allow for full recovery of the economy. And so, this, of course, is actually really positive for risk assets like stocks and gold, but again, not particularly constructive for fixed income. So in the next slide, you can see the very high levels of unemployment that had been reached during the pandemic. In the initial lockdown period, layoffs and furloughs caused the employment rate to spike to a level really worse than we saw in the financial crisis at around 14.7%. And this actually equated to a loss of all the jobs that were created since the financial crisis. So quite a blow. However, many of these jobs these losses were temporary, and the numbers come back in. We're closer to 10% as the economy has slowly reopened. Looking at the chart, you can see there appeared to be what was an uptick in wage growth. However, this was actually, if you dig into the numbers, really just kind of an anomaly because the loss of mostly lower paying jobs brought that average higher. It wasn't really wage growth. This is what Erin was alluding to before. This next slide is showing the federal funds rate expectations out in the future. And consistent with his comments about deflation and unemployment being the Federal Reserve's biggest worries, Jerome Powell has also said on many occasions that the Fed is not even thinking about raising rates. And so the market is really pricing Fed funds at zero for quite some time. So looking at this next slide, you can see the trend in nominal and real yields on the 10-year Treasury has been trending down for really decades. And currently the real yield, and that's the nominal yield adjusted for current inflation, is actually negative by about 88 basis points. Not very attractive. This trend in declining inflation has been attributed mostly to globalization and advances in technology over the last decade, which have really improved productivity over the years. The yield curve on the right-hand side of the slide deck shows a significant move lower in rates and a substantial flattening of the yield curve. And again, this is not particularly good news for fixed income investors as you're really not getting well compensated to move further out to longer parts of the duration curve. And finally, on this last slide, and this really isn't a surprise, this just huge amount of intervention by the Federal Reserve has caused credit spreads to compress while the experience of defaults is actually rising. And looking back, you can see this also occurred during the financial crisis. And what this really is an indication of is just investors reaching for yield in a very low rate environment and feeling some comfort to do so by the Federal Reserve's support of the system. But I mean, I would just keep in mind, however, that while the Federal Reserve is able to support the orderly trading of the credit markets, it doesn't have any mechanism to cure insolvency. So staying high quality in the fixed income markets is really important. In addition, the Fed has also indicated that they do plan to sunset this credit market intervention that they're doing at some point. It's targeted right now for actually year end. They would like to see the markets trade more freely on fundamentals without their support. So at that point, we might see some spread widening, at that point. So I guess the bottom line to all of this is that cash management operations for now should stay short and very high quality during this period of uncertainty, and expectations should really be for the preservation of capital and not really for reaching for any kinds of real returns. So that's a quick overview of the landscape specific to the credit markets. We thought it might also be of interest to do a high-level review of the economy. But so to break things up a little bit, we're going to do a quick polling question. So I'm going to turn it back to Emily to check in with you all.
Thank you. Our third polling question: when thinking about the economy, often economists talk about the shape of recovery. What are your thoughts on the timing of a recovery back to 2019 levels of earnings and output? And your options are A, V-shaped, with all of the financial stimulus that has been injected into the system and the prospects of a vaccine looking promising into year-end, the economy will have a robust recovery into 2021. B, Nike swoosh-shaped. The economy will fully recover, however, gradually over the next few years. Or C, L-shaped. The economic damage is severe and we will be in a high unemployment, low growth scenario for an extended time. And for those of you that would like a copy of today's slide deck, you can download them from the folder that says Slide Deck and Handouts to the right of the slide view. We will also be sending the slides via email after the webcast. We'll just give everyone another moment here. All right, let's go ahead and take a look at the results. Mel, back to you.
Okay, great. Yeah, well, that is not too surprising. The Nike swoosh shaped seems to be kind of the consensus. I think originally the market had hoped and anticipated for a somewhat of a V-shaped recovery, but as we all know, the persistence of the virus has turned out to be a little bit longer than we thought. So I think the general consensus is consistent with what you guys are thinking, which is a full recovery. However, it might take a little longer than we initially had hoped for. Okay, so we're going to take a look just at the bigger economy really quickly. This next slide shows, this next slide shows, again, this bubble slide, the current recession. And so with a drawdown of 10.2% of real GDP, it's really the sharpest and fastest that we've seen since the post-World War II demobilization. So it's quite an event. So the question is, how long will it take to recover? Most of you said it may take a couple of years, and we would tend to agree. This next slide shows all of the recessions since 1928. And of note is the macro environment that was present prior to each recession. So each recession before this one had one or more of the following macro elements heading into the downturn. A large spike in a commodity price, an aggressive Federal Reserve, or extreme asset valuations, in particular stocks or housing. Well, coming into this year, we really had none of these. Commodity prices had been relatively stable. The Fed had switched to a very accommodated stance on rates, and valuations were slightly elevated at about 19 times forward earnings versus the 25-year average of 16.5 times, but they were really nothing near extreme. So this time, we have a new and unknown catalyst that pushed us into this recession. This catalyst, of course, being the virus itself and the self-imposed lockdowns of many parts of the economy. So since we've not really seen this in modern times, it's more challenging for economists to anticipate, what this recovery will look like and how long it may take. So in order to very closely track the economic recovery, the Federal Reserve actually earlier this year created what they call the Weekly Economic Index, or the WEI, which is an index of real economic activity using timely and in-the-moment data. They created it to give us a real-time look at high-frequency data to gauge how the economy is doing in real time. As the traditional measures we look at, like GDP and unemployment, they tend to be lagging and backward-looking. The WEI represents the common component of 10 different daily and weekly series covering consumer behavior, the labor market, and production. And I won't go into all the different nuances, but they're, basically around gasoline, fuel consumption, steel production, unemployment, filing for claims, things like that, things that are in the moment and more timely. And what this chart is showing is that, yes, things have been recovering slowly since April, but, we do still have a fair amount of room to improve. And this next slide is also high-frequency data accumulated from other sources, including mortgage applications, consumer debit and credit card transactions, hotel occupancy, travel, navigation app usage, U.S. seating for diners, and TSA travel traffic. So while mortgage applications and debit and credit transactions have improved really nicely, there remains weakness in the hardest hit sector of travel, leisure, and dining, which we would, of course, expect those to improve really once we, find a solution to the virus itself. So from the data we are watching, there are reasons to be optimistic, of course. However, the ultimate timing and the magnitude of this recovery is still quite uncertain. So again, if you have questions, please go ahead and send them in, and we'll be sure to answer them either at the end of the presentation or by reaching out to you after. And now I'm going to turn it back over to Aaron.
Thanks, Michelle. I think that's really valuable information kind of in looking at how the current environment sets up today, and maybe we're headed towards that kind of Nike swoosh shape recovery. It probably feels like we're never going to change, but, we certainly will. And I think, the process that we put in place longer term is really critical. And really that process should be a process in place as we go through those rate changes, economic cycles, seasonality. It needs to be a long-term kind of view of things. It really should be to maintain that principle and try to collect some income along the way, knowing that we're probably not going to collect huge income today. This is really where we recommend going through kind of 5 different steps to determine a prudent way to structure your liquidity. And we think going through that process will uncover some opportunities today, but probably more opportunities in the future. So the first step here, take a look at your current exposure. What marketable securities do you have on hand, and what's the status of the liquidity, maturities, and titling of those assets? This could be really easy. Maybe you just hold cash, or maybe you hold several kind of laddered CDs because you're part of a CDARS program. Sometimes we see municipal bonds on the books here because the owner really likes a certain revenue project or even some random stocks. But it's really all about looking at the collection of those assets and evaluating your overall level of exposure to the risks that we discussed earlier. So step 2 in the process gets a little more interesting, as we start to look at business cycle. And I'd like to burn this graph into your head a bit. I think it's really important as to where we want to take things. So what we have here is weighted average dollars on the vertical axis, and that's just your cash on hand. And then we have time on the horizontal axis. So this looks at months over a couple of years, although you could extend this longer if you really wanted to. And you can see how our cash has moved along this curve. And you could probably tell a pretty good story. You could describe why you had this dip or why you purchased this type of capital equipment. Maybe you had shareholder payments. Could be a number of things going on. But when you go through this exercise, you can really start to parcel out what types of buckets your cash could be put into. And we really like kind of the 3-bucket approach. We think that makes a lot of sense for those in the construction industry. So starting with near-term liquidity, you're likely dipping into this more frequently throughout that cycle. Second bucket would be strategic reserves. Maybe you dip in here once or twice throughout that cycle. And then third, and I think this is where the opportunity really comes, is that idle cash. And this is just cash that remains in cash for that economic cycle. Of course, you'd love to forecast this perfectly, but I do think putting some ballparks around this and seeing where your cash flow has been gives us a general idea of where your buckets lie and what value we have in each. I think once this is done, you can now ask yourself, is there an opportunity cost to structuring this a little bit differently, and how would that affect my third parties if I did? So the next step is just kind of extending that line into the future by getting your crystal ball out and looking ahead. And this is obviously difficult, but I think you can make some reasonable assumptions based on a couple things. Projects or capital needs in the future, what use of leverage do you need, seasonality, budgeting, scheduling. That kind of gives us a whole nother data point here, and we can extend that line out. So what we have is, okay, where have I been? And now I kind of can see where I may be going. So the last step that doesn't involve ownership at this point is addressing those third parties. And Aaron alluded to this earlier. I can't underscore this enough. I think it's really important to be proactive with these parties and communicate any planning up front. I know Aaron and Elaine preach this from a business assurance lens as well. But obviously the first part of this is, what do my existing covenants look like? And if I were to restructure my liquidity, how would it affect my third parties? Just a quick example on this. A couple of years ago, we sat down with a large mechanical contractor, and they just sold a large piece of equipment and had a substantial amount of cash on hand. And we had several meetings with them as they were kind of talking about their options of what to do with that asset. Potentially, dispersing it to several entities or retaining it in the business. But the question that kept coming up during these meetings was, do past underwriting standards still apply? And how does that work now that we've turned this asset into cash? And so what they did is they formulated kind of a strategic plan in the framework of an investment policy statement. And they put that in front of their bank and their surety, and they walked them through it. And both parties were very comfortable with the moves they made. There was no negative repercussions for the moves they made. I think a large reason why they felt that comfort was because they had a good understanding of where the company wanted to go. And they were super engaged during those conversations. So, again, would really recommend you be proactive with those parties. So the last step in this process, is to address ownership and their really risk tolerance for the ownership. I think this may not apply to everyone on the call, but it certainly addresses those in the closely held or family-owned space where there's a strong link between the corporate balance sheet and the personal balance sheet. It's really going to be more of a global picture in that case. And, we often need to spend time here addressing the soft side of investing. So how do the owners feel about investing in capital markets? And I think some of the analytical folks aren't fans of this process because it's not an exact science, certainly an art side discussion. And so, a lot of times questionnaires, looking at risk metrics or providing context into historical market events can really help to address this. Or, identifying what is kind of the biggest absolute decrease you can stomach and building kind of an approach around that type of risk figure. Also, how can the owners look to diversify against other risks on the personal side? This is kind of that holistic view, and I think it's a big part of the conversation. This comes up time and time again in making sure that we're looking at everything for the owners. But, ultimately going through that 5-step process allows us to gather really good data to start to put together kind of a strategy within that investment policy framework. So on that note, we wanted to use our last polling question to learn a bit more about how many of you have an investment policy in place. This could be, a formal or informal document, but curious to learn, what that looks like for everybody on the call. Emily, maybe I'll turn it over to you.
Thank you. Our final polling question, do you have an investment policy statement? And your options are A, yes, or B, no. And once you have completed all CPE requirements, you'll be able to download a PDF of your CPE certificate from the CPE progress window to the right of the slide view. We'll give everyone just another moment on this final poll. All right, let's go ahead and see what everyone has to say. Back to you.
Thanks, Emily. This is interesting. I always like to look at some of this data. Looks like about a quarter of you do have one, whether it's formal or informal, and about 3/4 don't. I think the next few slides, really are designed, if you do have one, to maybe help you think through what you have and maybe add some other elements to it. For those of you that don't, the goal would be to kind of give you a framework here. So what is we call it an ITS. So what does an ITS look like, and what are the tangible items here? Many of you may be familiar with this as it relates to your 401k or employer plan. And this is, pretty similar to that process. I think it's a little more in-depth, but it's somewhat similar. For those of you who do have one, think of yours and let's compare. It's really all about time horizon and kind of going back to that graph we described earlier with those 3 buckets, segmenting assets into those buckets, the short-term, intermediate, and long-term, and then getting really tight on the risk level of each bucket. And the thing with risk is, you can control a lot of the risk bandwidth here within your investment policy statement. You fully recognize the amount of risk you take on and you outline that risk and monitor it accordingly. Of course, the investments are going to ebb and flow over time, but you can really readjust and monitor it if you have an appropriate bandwidth. Also, improving your cash flow and increasing your tax efficiency are outcomes here, and we'll talk about that in a second. But I'd say that the material large benefit here is improving that decision-making process and benchmarking your progress over time. If you take all this time and energy to put this in place, what economic value will it provide? I think that the great thing here is that you can measure that in very tangible numbers, real dollars, and you'll be able to see what that benefit is over time. So again, just going back to that rolling cash graph, the investment policy statement simply takes those buckets and kind of further defines a solid plan for them. And we just continue to monitor and adjust how we invest these buckets based on available cash, capital needs, and interest rates over time. As far as assessing underlying risk goes, just a couple things I'd go over broadly here. Credit quality, only invest in investment grade or high grade securities, to Michelle's point, especially in a time like this. Position sizing, don't get too excited about any one position. 5% is generally the maximum we'd recommend. You want to have at least 20 to 25 positions to get adequate coverage. Diversification, those whole tenets apply. And that includes position size, geography, type of security, and then laddering would be the final element here. You really want to spread out these income maturities along a timeline so that you fight interest rate risk. Tax efficiency, it's great to bring this to a tax planning meeting. Specifically, I'd say there's kind of 3 items you want to look at. Biggest piece here is the allocation between tax-free and taxable income. And I think California is a perfect example of this. The muni bond market down there is still in high demand to eliminate state taxes. You get tax-free return at the federal and state level with those. So even in this low rate environment, you get a lot of demand there. But there are other more attractive yields with taxable bonds at different maturities depending on your timeline. So I think it's important to look at both. Capital gains management, right now there are a lot of embedded gains in fixed income due to the reduction of rates over time. Some of the graphs that Michelle was showing kind of showed that historically. And so really evaluating, should I take these gains? Am I an S or a C Corp, and do the gains flow to my owners? That's important to consider. And then lastly, being mindful of alternative minimum tax with the flow-through entities, specifically any investments in private activity bonds as they are subject to this. So you want to be careful with those. Just super quick on logistics. This is a structure that we think makes sense. You obviously have a bank account with cash on hand, and then you have a general ACH link to your strategic reserves. This is that short-term liability matching bucket. And then we see kind of a connection to the intermediate and long-term where you want to drive more yield. And that bucket may grow. You certainly want it to build up, and maybe you hit a certain threshold and then move money into the bank account or buy, some more bonds that provide you with higher yield. So let me jump ahead here. So in terms of, one of the biggest pieces here is improving your process over time. The ICS process allows us to kind of have a historical record and improve upon that. I think from a benchmarking standpoint, you really want to look at it in a simple format, whether you work with an advisor or you do reporting yourself. It's what did I put in? What did it generate, both in terms of capital preservation and income? What did it cost me in total? And that should include transactional costs or any ongoing fees. And then what was my net result in percentage and total dollars? And then how does that relate to an appropriate benchmark? Obviously, you want to be keeping up with those benchmarks. So we think going through that 5-step process helps you to potentially restructure some of that liquidity and ultimately create a competitive advantage for your business. And I'd say even in this low rate environment, I think there's a lot of benefits you can gain from going through this process. And with that, Emily, I'll turn it back over to you.
Great, thank you. We are just at the top of the hour, so unfortunately we are out of time for questions. However, I would encourage you, if you have questions, you can still submit them in our Q&A window, and we will do our best to follow up with you after the presentation. And thank you so much, Erin, Michelle, and Elaine, for a great presentation today. As a reminder, if you attended today's presentation in a group and would like to receive CPE credit, you must complete the group attendance sheet found in the slide deck and handouts window to the right of the slide view. If you participated as an individual and met all certification requirements, your certificate is available to download now in the CPE progress window. I'll keep the webcast console open for a few minutes to give you time to download your CPE certificate. A copy will be emailed within 3 weeks should you have any difficulty downloading it now. Here is a link to an online survey where you can provide feedback for today's presentation. Please take a moment to complete this survey as your feedback is very important to us. Thank you for joining us, and we hope you'll join us again next time.